You want to start investing? What's next? For us, we go through principles of successful long-term investing with all of our clients. This is provided by JP Morgan. We think it's actually really good stuff. So, principle number one, plan on living a long time. So, what you see here, what this chart is showing is if you're age 65 today, what's the probability of living to a specific age or beyond? And if you're a woman, a man, a couple, if you smoke or if you don't smoke, and what you can see if you don't smoke, and for a woman, age 65, she's got a 73% chance living to age 85, 53% chance living to age 90. Men, 64% chance living to 85, 43% chance living to age 90. And couples, even better, even higher probabilities of living to a specific age. So, principle number one, plan on living a long time. Principle number two, so important, cash isn't always king. So this chart, this fantastic chart, shows us the percentage of time a 60-40 portfolio, so 60% equities or stocks, 40% bonds or fixed income, percentage of time 60-40 returns were positive or outperformed cash. And this is on a rolling monthly basis, 1995, 2024. And the gray bars, that's the percentage of time a 60-40 portfolio was positive. And then the green diamond, that was the percentage of time a 60-40 portfolio outperformed cash. And when you look at a 1 month, 6 month, 1 year, 3 year, 5 year, 10 year, I mean, it's pretty consistent. 60-40 portfolio is positive more often than not, outperforms cash more often than not. Yeah, there are some outliers. 10 years or 91% chance or 91% of the time 60-40 portfolio outperforms. So there's a small percentage of time it doesn't. But the vast majority of time, a well-balanced portfolio is going to outperform cash. So principle number three, compounding makes a difference over time. Super important. So this chart, we're looking at a change in purchasing power by investments in major asset classes. So we're looking at the growth of $10,000 adjusted for inflation from 1995 to 2024. And what you can see, the purple line is cash. Purple line, the purchasing power of cash has actually come down a little bit. You started with a purchasing power of 10,000. Well, inflation eroded that. That $10,000 only now has the purchasing power of about $9,198. Corporate bonds, so high quality corporate bonds, purchasing power, it's grown. If you had $10,000 back in 1995, purchasing power has grown to $23,182. But look at stocks. So S&P 500, Russell 2000, large company stocks, that $10,000 now has a purchasing power of $79,000. Small company stocks like Russell 2000, purchasing power of $81,000. So what really keeps up with inflation, and more importantly, what actually beats inflation over time, it's actually equities and even bonds, not cash. So if we take a look at the next investing principle, principle number 4, avoid emotional biases and stick to a plan. Again, critical. Love this chart. We go over this chart with all of our clients. And what you're looking at here is you're looking at the Consumer Sentiment Index and subsequent 12-month returns of the S&P 500. So this blue dotted line running across, this is the average consumer sentiment. When the gray line is above that, sentiment's good. It's better. The higher that gray line, the stronger the sentiment, the more positive the sentiment. As the gray line dips, sentiment gets negative. There's a lot of pessimism, a lot of fear. And you can also see here on this chart, there are dots at the top, dots at the bottom. So these dots at the peak represent sentiment peaks when people were feeling really, really good, right at the peak of their sentiment feeling. And then these dots at the bottom, at the troughs, these are low points. This is when there's a lot of fear, a lot of pessimism, frankly, a lot of panic. What is so interesting to see, though, is if you look at the average subsequent 12-month return of the S&P 500 and you look at the 10 sentiment peaks, the average 12-month return of the S&P 500, only 3.9%. Now, on the flip side, you look at the sentiment troughs, the 9 sentiment troughs, the average subsequent 12-month return of the S&P 500, 24.1%. So this really kind of brings home Warren Buffett's adage, be fearful when others are greedy, greedy when others are fearful. When other people are fearful, that's the best time historically. That's the better time to start buying into those dips. That's where you get those outsized returns in the long run. When everyone's feeling great, be cautious. Historically, that's when markets don't perform nearly as well. And if we take a look at the next principle, 5, volatility is normal. It's just part of being an investor. Don't let it derail your plans. Absolutely love this chart. We show this to all of our clients when we're meeting with them. Volatility is normal. And what you're looking at here is you're looking at the S&P 500 intra-year declines versus calendar year returns. So the red dots, those are the intra-year declines. That's how much the S&P dropped that year. The gray bars, that's where it ended that year. That's the annual return for that year. The average intra-year drop of the S&P 500 is 14.1%. 14.1%. That's a lot higher than most people realize. And when the media is talking about the stock market's down 10%, like that's really historically not that big of a deal, very much within the range of normal volatility. We don't really start getting excited to buy dips until we see a 20% correction. Now, despite the average intra-year decline of 14%, annual returns were positive 34 out of 45 years. So you can see all these red dots and look at all those gray lines and how much better the S&P did relative to that red dot pretty consistently. And if we go all the way back to COVID, the S&P dropped 34%, and by the end of the year, it finished up 16%. That's a 50% swing in 1 year. Even year to date, we saw a lot of volatility. S&P dropped 19% right after tariffs were announced. Liberation Day, markets start selling off. Well, we've seen those extended. We've seen some different developments in trade, and we've seen year to date the S&P 500 more than recover, up 5% year to date. And then principle number 6, staying invested matters. Again, such a powerful principle, something to be mindful of. And this chart shows us the data. So what you're looking at here is you're looking at the range of stock, bond, and blended total returns, blended being a 60-40 portfolio. It's kind of your average moderate portfolio. And if you look at range of stocks, and this is going all the way back to 1950, all the way to 2024. And going back to 1950, looking at rolling year returns, any 1 year period of time, stocks could be down 37% or up 52%. That's the range in any 1 year time frame. Bonds, people think bonds don't go down. They actually do go down. They just usually don't go down nearly as much as stocks. But if we look at the range of returns of bonds over any 1 year time frame, bonds could be down 13%, but they could be up 33%. 60-40 portfolio, somewhere kind of in between those two ranges. Worst year for a 60-40 portfolio, down about 20%. Best year, up about 34%. But what's so important is staying invested. And what happens to the ranges of volatility as your rolling periods of time increase, as your time frame increases? Well, you look at 5-year rolling periods, look at that, how much that volatility has shrunk, how it's narrowed. Stocks, over any 5-year rolling period of time, they could have been down 2%, worst case scenario. High end of that, better case scenario, up 29%. Bonds, you can see that range narrow, 60-40 portfolio narrow. So this is why we say, it's so important to stay investing. And when investors say, hey, what's your time frame for long term? It's not 1 year. 1 year, you have a ton of volatility. It's really 5 to 10 years. And you look at, a 10-year rolling period, even a 5-year rolling period, a 60-40 portfolio has never actually been negative. Worst it's ever been is just positive 1%. Same with 10-year, and a 20-year worst, down 5%. So staying invested matters. And you can really see that in this chart. And then another principle that we share with all of our clients, investing efficiency has its advantages. So this is really just talking about tax efficiency. And we're going to talk a lot about this in future videos. But, is your investment a passively managed exchange traded fund, an actively managed exchange traded fund, passively managed mutual fund, actively managed mutual fund? You want to pay attention to the tax consequences, capital gains, interest dividends, because it's going to have a drag on your investments. We'll talk a lot more about that in future videos. And then, principle number 8, diversification works. It really, really matters. Love this chart. We call this a quilt chart. It's showing a lot of different asset classes. So every row is a different asset class. Every column is a different year. And it's just showing you, hey, what did this asset class do in any given year? So in 2010, REITs, real estate investment trusts, they were up 27.9%. On the low end for 2010, cash, pretty much flat, up just 0.1%. Fast forward to, a different year, 2013, small company stocks were up 38%, large company up 32%, commodities down 9%. And what you see here is across the middle, you see this gray, the gray boxes, and that's just a balanced portfolio, roughly 60-40. And with a balanced portfolio, you can see year over year, it's always just kind of somewhere in the middle. But over here on the left, you see the average from 2010 through 2024. So the average annual return, yeah, large company stocks did the best, but they had a lot more volatility. If you look at the volatility, they were at 15.1%. Small company stocks up 10%. Your average annual return 10%, but volatility was 20%. So you look at a balanced portfolio. Balanced portfolio is kind of somewhere in the middle. Averaged about a 7% annual rate of return. Volatility quite a bit less at 10%. So diversification always kind of keeps you in the middle. But really important, diversification means not all of your eggs in your basket, not all of your eggs are in the same basket, meaning not everything's going to be moving in the same direction at the same time. What that also means is you're always going to have something doing probably well and something that's not doing well, something that's flat or maybe even down. Avoid the temptation of just saying, hey, I'm going to sell what's down and move into what's moving up. Because if you do that enough, you're not going to be diversified anymore. You're going to have, everything invested in one idea or one asset class. And so it's really important to remember with diversification, that means not everything's going to be moving in the right direction, which means sometimes you're going to have things not doing well that year. That doesn't mean you sell it and you avoid it. It means you stay disciplined and you rebalance. So those are some really important principles we review with all of our clients. I think it's